I'm joined by Rachelle Kroon. Rachel is director and founder of Sphere Home Loans. Sphere Home Loans is one of the largest mortgage broking businesses in Australia. They help a lot of our listeners on the Money, Money, Money podcast, and they're great. They've got a team that's dedicated to helping listeners of the Money, Money, Money podcast. But today we're answering your questions, particularly for those who might be over age 50, about everything to do with mortgages. Rachelle Kroon, welcome to the podcast.
Thank you for having me.
Well, let's get into it. Before we kind of start, Rach, you've got a bit of an update, and I'll just kind of time stamp this or date stamp it. We are recording this on March the 13th, 2025, and I think this episode goes up next week. So it's pretty live update. But what's our hot off the press update?
Yeah, well, actually, one of the banks came out just this week and have announced that they're going to be doing no mortgage insurance loans for some of our essential services. So police officers, firefighters, nurses, and ambulance people. So that's a really big change for us.
Yeah. And it wouldn't be a podcast without me saying occupations like butchers, bakers and candlestick makers, I assume they're not on the list yet.
They are not on the list. Traditionally it has been sort of your accountants and your lawyers. Yeah. But I think for the essential services to be introduced this week is a really positive thing. We've been waiting for it for a long time. So all of my team are really excited.
Yeah. Is that just in your kind of mortgage broking world, do you see if there is a major, because I think that's a pretty major policy change.
It is a major policy, yeah.
Do you see the other lenders following?
They will want to follow. So especially with something like that, they're going to get a lot of traction. So we'll find the other banks will start to loosen up their no mortgage insurance policy soon.
Yeah. And another little update. So just on that, if you are a paramedic, police officer, firefighter or a nurse, the lender's mortgage insurance waiver, that is a game changer. If you've got children, because people who are 60 listen to this, Rach.
Yeah.
If you've got children in their 20s and they're one of those professions, forward them this episode and say, hey, just listen to the first 10 minutes because this will be a game changer for their property journey. And it could be the difference with using a mum and dad parental guarantee or not.
Of course. And it can just cut that time off getting them into the market, which is what everyone's trying to achieve.
Absolutely. Now, another little hot off the press. Well, it's not really hot off the press. Tell me to shut up and go away if you don't want me to say it. But before we press record out in my kind of waiting room area, with the latest interest rate drop a few weeks ago, most of the majors reduced their variable rate by 0.25%.
They did.
Your team did some research and found something very interesting.
Yeah, well, we found that some of the people that have been approaching us this week have been from a certain lender that has not reduced. And as of today's date, they are not passing on the 0.25. So that's a really big thing because all the other banks have. So it's quite shocking to us to see that one has chosen not to. I'm
smiling because I'm going to name them.
Are you?
Do you want me to? Or do you?
If you want to.
Yeah, I don't care. So those lenders are Virgin Home Loans, whatever that thing, and also Bank of Queensland.
Yeah.
So I actually, full disclosure, I used to be a customer of Virgin Home Loans or Virgin Money for one of my properties. And it's almost with the whole Virgin thing when Richard Branson woke up one day and he's like, I'm going to have Virgin Gyms, I'm going to have Virgin Wines, I'm going to have Virgin Airlines, I'm going to have Virgin Cruises, I'm going to have Virgin Money. It's more of a badged thing. So Virgin isn't its own bank. They use Bank of Queensland.
Yeah, which is why they're together in that.
So it's just interesting. I needed at the time, and this is why, and we will get on, but I just wanted to kind of set up this with the mortgage broker. It is really important to have a good relationship with your broker because things can change.
They do.
And at the time when I needed that loan with Virgin Money, they were the lender that suited my needs at the time. And it was a great rate, relative, it met my needs. But I recently refied and they couldn't meet my needs. So went to another place. So it's not to say we refinance every 10 minutes, but at least if a customer of yours, for example, or one of your team member clients, because Rach, you've got a handful of brokers that help all our
Yeah, we've got
listeners.
7 brokers that work across Australia.
Yeah. So one of your 7 brokers, if a client reaches out to them and say, oh, hey, Virgin or Bank of Queensland, I haven't seen the rate decrease, your broker can say they're not doing it at the moment. However, because it's been 4 years since we actually did anything, let's run our eyes over your current situation because we might be able to make it easy to get another lender that's maybe a more competitive rate and maybe more suited to those current needs.
Yeah, and I find that over, we've got clients that we've had a relationship with for a decade. We find that there are different banks that meet their needs at different times, but it's very rare that it's rate driven. A lot of the time it's your stage of life driven.
Yeah, and that's kind of what I was saying, my little spiel there. I'm like, no, Glenn, because the rate, it's nice, but potentially when I did get that Virgin Money home loan, I know it was a little bit more expensive than another lender, but because it met the needs and self-employed, and that's another topic. And I know this is the Retire Right podcast and all that, but just if you are sending this to any of your kids just to listen to this, the reason that I had to go to Virgin Money, and just so we'll just call Virgin Money Bank B, right? Yeah. Or Bank C or Lender C. The reason I had to go to Lender C was at the time when I was purchasing a property, they were the only options for me because I did not have a job.
Oh, wow.
Rewind 3 years before that, I had my financial advice business. I had a good income, stable income. If I went and bought that property tomorrow, I could, but it was an off-the-plan property and it wasn't completed until after I started the podcast. And then on paper, I didn't have a job because I literally sold the financial planning business, had all this cash in the bank, started to build income from the podcast world, which is very hard, and that met my need because I needed to settle on that property and ended up keeping Virgin Money for well over 2.5 years. But it wasn't a bad lender, but I wasn't going there because it was potentially at the time the sharpest rate. They were the ones that suited my needs.
Yeah.
So what about that for an intro? Let's let's get into the questions. 10 minutes almost into it. All right. Rachel, there's 3 questions here. I'm going to read each of them because they're only a sentence each because I think there is some overlap.
Yeah.
So I'm going to read them and then I'll give you the floor. Daniel said, how to get a mortgage or refinance one once you are in retirement. What do banks look for in this scenario? So that's the first one. The next one from Felicity, is it possible to refinance and move IPs to a new lender, and that's investment properties, when you're over 65, working part-time with a partner under 60 no longer working? So, different age and stage, one's working, one's not. And then Constance said or asked, is it worth looking at refinancing when your PAYG, and that's pay as you go, which basically means you're an employee, your PAYG income has decreased and been replaced by passive income? 3 situations there. What's the deal with those things, lending, pre-retirement, during retirement? One's in retirement, one's not.
Yeah, and I think it's really common now that people are holding properties past retirement. I think because of different investment property strategies, people are opting for certain things that they want to hold investment debt after they have retired or they're semi-retired, and we see that a lot. And the answer is yes, you can still borrow at any stage of your retirement as long as you meet the bank's requirements for income. So there's 2 things that you need to be able to satisfy a loan, which is income and equity. So equity being how much, equity you've got in the property, and most people in this sort of situation have a lot, and then income.
Can we call that, and tell me if you can't, security?
Yeah, you definitely could. So the equity is, how much security you've got.
Because the banks want to know that they do have some recourse. So, and that's common with, because I talked with someone the other day and they just didn't understand that you needed both of these tick boxes.
And that's really common because years ago we could lend just on equity. Income didn't come into it as much.
Interesting.
But since the the Royal Commission Responsible Lending,
GFC,
all of these things have come in. So the banks might want to lend you money well after you don't have an income, because for them the risk is low. They've got plenty of security or equity. They're not taking a risk. But the government have come in and said, well, we won't allow you to take that risk. We want to be able to, you need to be able to show that you have the income to cover that loan. So if you have retirement income, and that might be passive income from properties or shares, that just goes into the bank's calculators like anything else would. And as long as you can service the loan on that income, that's fine. So a lot of the time we do see people have a combination of, they're drawing down income from a share portfolio, there's some investment properties, but you put that income in the calculator minus the debts and there's still a surplus.
Yeah.
So in that case, yes, you can still borrow and well into retirement.
So for Constance, for example, she said she's PAYG income has decreased. So she may have started an account-based pension from her super, and her, I guess, weekly financial needs are met because of some of it is working 3 days, some of it is supplemented by her pension. The banks and lenders will see any income as long as it's regular and ongoing.
That's right. And I actually saw a file recently where the client was still working but had reduced their hours quite substantially.
Can you twist that mic just a little bit that way? Yeah, perfect.
Huh?
Yeah, sweet.
I saw a scenario quite recently where a client had reduced their income through their paid employment because they could. They had a lot of properties and they had no reason to be working full time. But their bank wouldn't actually accept a loan that had more than 50% of the income of the application coming from rental income. That was just a policy that this particular bank had. And we were able to place that with several banks, which was a really easy thing to do. But they had been with this bank forever and they were just shocked to hear that they couldn't get that loan. So that could be quite common.
Yeah. So Felicity here. So for Constance, it's pretty much all good, but go to a broker, because if you walk into the local branch, their policy might not allow a pension income where a lender next door may.
And I think that's why it's so important. A lot of people in this demographic, a lot of this age demographic may not have used a mortgage broker before because, Constance, if you've had the same bank for 30 or 40 years, what reason would you have to go to a broker where, 75% of Australians are using a broker now, but that's probably more, the newer people coming in. So a lot of people who are heading to retirement may not have used a broker before, and this is all new to them. So when their bank says no, their first reaction, like would be for you and I, is to go to a broker. A lot of people wouldn't, or they haven't dealt with anyone but their bank before.
Yeah, and I get that it's a big deal. Like, we have financial advisors and obviously mortgage brokers where if you go to the retireright.com.au, click get help and say, I would like to speak to a financial advisor. And I had one lady, and thank you so much for actually replying, because I actually personally look at those inquiries and I'll introduce them. I sent her to a firm that was in a different state, because all our businesses, be it the mortgage brokers with Sphere or the financial advisors, it's all remote online and they can help listeners all over Australia. And she said, I live in Perth. Adelaide's a bit long a drive to get to. And it's like, no, that's okay. If you're comfortable, we can do it online. But there's just isn't, I can't give everyone a mortgage broker or an advisor face-to-face in every suburb in Australia. And with, the online security and Teams meetings and Zooms, it can be done and you can get a good outcome. So I just wanted to jump in there on that area. But in relation to Felicity, realistically, it seems like there's a lot going on. Refinance the investment property to a new lender. She's over 65, working part-time, and the partner is under 60 and no longer working. I actually might lead this, and there's a question, Daniel's question about, can you do it once in your retirement? And then there's another one from JP, what's the oldest age that you could get a mortgage to? So realistically, are you saying as long as there's income to support and security, And potentially, what's the third magic thing?
Well, the third magic thing, especially when we're talking age, is exit strategy.
Awesome. I was going to be like, it is, ta-da. And imagine if you're like, what are you talking about, Glenn? But yeah, so there's a third thing potentially when you are maybe north of 50, 55.
It's actually over 40 now.
Really?
So a lot of the banks want an exit strategy over 40 because we're doing 30-year loan terms. So, if retirement age is 70, then really if you're getting a mortgage now and that's going to go for 30 years, the banks still want to see what you're planning on doing it, paying that out.
So before we ask age, let's explain exit strategy. What does that mean?
Yes. So exit strategy is your strategy of how you're going to exit that loan. So
not the house.
Not the house, but the mortgage.
Yep.
So there's a responsibility that the lender has that you can pay out that mortgage. So if you're going to take a 30-year loan term and you're 65 and the government says that your retirement age is 70 or you plan to retire at 70, what happens in 5 years' time? Now, there's a lot of different things that can be part of an exit strategy. And this is where it gets complex with lenders because all different banks have a different interpretation of what exit strategy is acceptable. So some will say, oh, well, super can just pay out your loan on retirement. But some will say, well, we don't want to see all that super paying out your loan at retirement. Some will let you put downsizing your owner-occupied home as part of the exit strategy, where some don't accept that. So when it comes to exit strategy, and we're comparing lenders for people. So if I was doing a scenario for Daniel, and we were looking at the scenarios that were best suiting him, I wouldn't just be comparing rates and products. I'd be comparing the exit strategy that the bank has as part of their policy and giving the lenders that would accept his exit strategy as part of that comparison.
Yeah, I'm just kind of walking and trying to chew gum here at the same time. To some lenders who won't potentially accept super or pensions as exit strategies is because if you've got an account-based pension and you're over 65, you could pull it all out tomorrow and go to the casino and it's gone the next day. But they might say, well, at least we know we can use the house as the exit strategy because literally you'd have to sell the house.
Yeah, and some will say like they don't want you to use all of your super to pay out that mortgage because they feel that super's there to live on, where some banks will say, well, as long as you've got enough super to cover that mortgage, that's fine.
Yeah, cool.
And some will use proposed super and some won't. And that can be a really big difference between them because if you're 60 and you're looking at retiring at 75, let's say you're in an industry that you can work till 75, there's a big difference between what your super balance is now and what it actually will be.
Okay, so they'll go, okay, assuming your situation, we think over the next 15 years there might be $10,000 of contribution, so we can safely assume that there could be an extra $150K in super by the time that age comes.
That's right, and I was working on an exit strategy with one of the brokers recently that it was actually quite a tough exit strategy. They were lawyers and they were going to work till a lot later than some banks will accept. So they had planned to work well into their 70s, and as lawyers they can. But there's banks that will just say our rule is black and white retirement age, where some banks will say, well, if your plan is to work to 75 and you're in an industry where you're not a physical labourer, you can work until 75. We will allow you to put that in your strategy.
So when some lenders look at quote unquote retirement age, do they just peg it to the age 67?
They do.
Where you can qualify for age pension.
That's right.
Yeah, cool. So for JP's question, what's the oldest age you can get? For Daniel, Felicity, and Constance, there's probably not too many showstoppers if you still wanted to dance with mortgages.
That's right. And we have got a particular client that was still lending in their 80s because they were a property investor and they still wanted to be extending.
Clearly not a good one. Wouldn't it be done by then?
Well, it was properties that were probably more for generational wealth for him.
Okay.
Like they weren't properties that he was going to use in his time, but he didn't want to be paying the principal down with his super. He wanted to keep extending interest-only terms.
Wow.
So he was borrowing, but more so just keeping the debt that he had and structuring it for his strategy.
There's a question here from Kylie, and it is about, and look, 20 years ago, this word was thrown around everywhere about bridging finance, a bridging loan. Kylie said, not sure if you'd cover it in this podcast. Nah, we're not going to do it. Definitely will not do it. But how does bridging finance work? If you want to buy a bigger house but will need to sell the current one to help fund the new one. So bridging finance, is it still a thing? Do you still use it? What's the deal?
Yeah, so bridging finance is still a thing. So bridging finance, I think traditionally has been designed for downsizers. So, you've got a big house and you're downsizing, or you've only got a very small mortgage and there's not a lot of risk for you, because when a bank does a bridging loan, what they do is they take the house that you have now and they refinance any debt that you have. And then they take the security of the property that you're buying and they control the process. So they give you a loaded rate for the period that you're holding both, and they set the terms. So they might say, well, you have to sell that property within 6 months or within 12 months. And if you were to not, they can actually enforce the sale. So people are right, there is some risks involved in bridging finance. I would say a lot of people come to a mortgage broker asking for bridging finance and they tend to get something else, which is either a loan to be able to hold the two properties for a period of time, or they're buying or selling with an extended settlement period. But bridging finance is still there. It just gets used a lot less than one might think.
Do you think that's just the nature of the environment that we're in, that more properties now in Australia have more equity and it is probably cleaner and less risky to do a short-term mortgage split off the current one, get the new one in place, and then we'll let it sell, and it's just less on the line, less risky?
Less risky. So bridging finance does have some risks involved and also can get quite expensive because there is that loaded rate that's
so what would a typical rate be for a bridging loan at the moment?
So a bank might use their standard variable rate. So if a standard variable rate is, say, 8% right now, but a real mortgage rate might be 6%.
Because they do the discounting
thing.
Yeah.
Yeah. So you're getting the standard variable rate for the bridging period. Now, if you hold those two properties for 12 months, that can be quite expensive. Now, for some people that are not going to have a mortgage at the end of the day, and, it might be somebody who's downsizing their home and they've had their property for a long time, it's worth it to them. But for a lot of clients that are upsizing, it's not the option they choose when they're presented with all the options. So when you are looking at upsizing your home, the mortgage broker will give you the options of bridging if you qualify for that, as well as buy before you sell before you buy, and a few other options. And then you will choose what's right for you and your risk appetite.
Can you use a deposit bond for the new property?
You can use a deposit bond for the new property if you've got an unconditional approval of finance. So a deposit bond is when somebody covers you, you don't have the 10% there.
But you pay a little fee.
But you pay a fee. That might be $1,500 and they cover you for a period of time. It's a percentage of the deposit amount. But if you can be approved to hold the both, or if you do have bridging finance and it is approved, then you can get a deposit bond to cover you. Now, if you're going to be risky and say, I'm going to buy a house with an extended settlement period, but I'm actually going to sell my property eventually, but I don't have that sorted yet, I'm just going to take the risk of making sure I sell before I buy. You need to have the cash in your bank account to do that, because you can't get a deposit bond unless you have a formal loan approval.
And with the bridging finance, if to pull the trigger on it, do I have to have a contract exchanged, or do I talk to the broker first and get in principle, we can do it now, sign and exchange?
You talk to the broker first. It's always good to have your ducks in a row before you start negotiating on the next property. So if you're looking at upsizing your home, I would say you would go and see a mortgage broker sooner rather than later. You would get a real estate agent out to value your home and tell you about what you need to do to sell. You would also get the broker to organise a bank valuation of your home, because you want to know what the bank values it at. That's going to come into play as well, because if the agent says it's worth $900,000, but the bank says it's worth $800,000, well, if you're trying to do a bridging finance loan, they're only going to use the bank valuation. So I think if people are looking at buying and selling, a bank valuation is a really important thing to get as well.
And you'd only tend to look at doing bridging if it was a rising market. So you know that we think the real estate agent's like, we can actually get this house moving within 2 months or something like that.
Yeah, I would say we do a proper bridging loan very rarely, because it does have a lot of risk, and a lot of our clients are upsizing, so it doesn't suit their needs.
So just a quick question on that, and maybe it's an education piece for people that might not fully understand the mortgage broker world. I can go to Bank A in the shopping centre and they say, yep, Glenn, you can have a mortgage. It's 6.19%, principal and interest, awesome. I can go to a mortgage broker who doesn't charge a fee and you can go, yeah, Glenn, we can get you that same bank for 6.19%, so same rate. But in the background, the bank remunerates the broker for doing all the work in the background. So it's not an out-of-pocket cost for the customer. And the bank are literally just outsourcing the work to brokers.
That's right. So I'm ex-major bank and I worked in their broker division, which is also called third party. So we were actually the cheapest acquisition channel for new clients for the bank in that time, because in first party or branch world, they had their fixed costs like
shopping centre
rent, regional managers, home loan managers, and they're paying all those fixed costs whether they write home loans or not. Where the broker channel, which is where I worked, I think I look after 300 brokers while I was there. So they're paying my salary to look after 300 brokers, but all those brokers are paying their own fixed costs. And the bank, we were only paying the broker for settled loans.
Yeah.
So it was actually quite a cheap acquisition channel for us.
So given that, is there sometimes hesitancy or hesitation, is probably the better word, for some brokers to do bridging finance because do the banks pay remuneration for a bridging loan?
Well, there was a time where we were able, so if there's a bridging loan that doesn't have an end debt, so let's say somebody's retired and they're doing a bridging loan, there's no income being used. There was a stage where we used to do that as a favour and we weren't getting paid for that. But now the banks have actually changed. They don't allow the brokers to do bridging finance if there's no end loan.
If there's no mortgage at the end.
If there's no mortgage at the end loan, because it's a
lot of paperwork for the banks.
It is a specialised type of lending. So let's say one of the major banks, for example, will only do bridging finance with no end debt for their own customers. So you already have to be a customer of that bank. And there's other banks that will charge you a fee for that particular service. So if somebody came to us and there was no end debt, we would refer them on to the most appropriate bank for them to go and deal with directly. But a lot of bridging loans will have an end debt and then there is an income still and we can do that for them.
Yeah, it's interesting because, a lot of people know my parents are recently retired, 70, 71. They purchased an off the plan in Brisbane. It's in an apartment building. I think they're level 5 of level 6, not hugely high. And they're not loving apartment lifestyle.
Oh.
They've got no mortgage. They've got money in super. And I'm like, well, just sell and go and buy a townhouse in a complex of 3 and Dad can get his little garden and grow veggies and do all that stuff that I think they're missing a little bit, and then not having all the politics of strata committee and all that drama. But for them, because so when Rachel, you say and debt, it means when everything's washed up and done, there is a mortgage at the end of X amount.
Yeah.
But in their scenario, they would need to buy another property, we'll just call it 700 grand, sell their current house for 700. Traditionally, yes, a bridging loan could work, but because there's effectively no end debt, are their options now limited, or do they do something and just pay a fee?
Their options are limited, but there are banks that will do that for them. They would need to deal with that bank directly.
Yeah.
However, in those cases, unless a lot of the time when we speak to people, there's other options. So your parents might be able to have a look at what they want to buy and after they sell, and it might be something that they think they can find quite easily. Well, to lessen their risk, something they might do would be sell their home, and let's say in the standard settlement period, 6 weeks. You can negotiate that at the start. So when you're preparing your sale contracts, you might say, I'm going to put a 12-week settlement in there.
Yeah.
And they might sell with a 12-week settlement and give themselves time to go and look. That way, they're not actually risking committing to a price before they know what they're going to sell for. And in my opinion, that's a lot less risk to your parents than entering into a bridging finance arrangement.
Yeah, because I kind of said to them, I'm like, well, how I would do it is pretty much that. I'm like, put the thing up for sale. Awesome. Just put it up. If you get something that's a good deal or whatever, tell them, yeah, it's a 3-month settlement, something like that. Then pay John's team, get a buyer's advocate in that area because they'll get properties that are off market and go hunt down a 3-bed, 2-bath garage and a courtyard, no more than 4 in a complex in this area. Go find a place and because nothing's urgent. And if you can I think it's possible. And I said, worst case scenario, if you couldn't find something, well, just bloody sell and just rent somewhere for a year and then slowly look. Because this is the problem. We can't pull all their money out of super to buy the new place, do a hot skip and a jump, and then when that other place sells, get that money back into super.
Yeah.
So, yeah, it's good. And this is why we have professionals, because I'm learning different options as well. And I think a bridging loan is off the table because it's not urgent. They've got time. And yeah.
And even though we don't do bridging loans without end debt, I still encourage our clients to call us if that's what they're planning on doing, because I do spend a lot of time showing people the other options that they could do, which I think could have a lot of less risk, just like that one.
Awesome. We'll be back right after this. Okay. Chris. Hello, Chris. What's happening? Oh, Rachel, we didn't do the community segment of the week. Can you scroll down and there's a Dropbox link in that document? Then we'll get to Chris.
Yeah.
If you open that Dropbox link, we asked everyone in the Facebook group if you could go back and give your 20-year-old self one piece of life advice or financial advice, what would it be? There's going to be some doozies here, I'm sure of it, because I'm only reading them as it comes in. In this segment, Rach, we just read their first name and let's play tennis. Let me know when you've got it up.
Got it.
Darren said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it.
Oh, profound. Mike says, contribute extra into super from day one. Easiest but least sexy way of becoming a millionaire. I have plenty of friends who were encouraged by their union to make extra contributions, and despite being on very average wages, they are now retiring with $1 million plus in super.
Love that. Todd. Ooh, bit of salty here. Choose your wife wisely. Very costly if you don't. One of your exes might say, choose your husband wisely.
Virginia says, plan for your retirement from the day you start work.
Oh, gosh.
That's great, Virginia.
Carla, I would tell any 20-year-old to put your super in high growth. Awesome.
Jen says, it's okay to have children alone and still be financially savvy. Getting married and divorced from the wrong person can end up costing you so much more. I hear you, Jen.
Jenny said, get yourself a financial mentor. And if you don't really have one, use this podcast as your financial mentor. We are here and mentoring it. But then again, this is looking back, what would you do 20 years ago? So we're here now, so you probably don't need one.
Michelle says, balance work, money, and enjoying life. It's not all about saving for retirement.
Yeah, that's a good one. Miriam, get a financial planner to make a plan.
Heather says, buy a property in a trust and not your personal name. Make yourself the beneficiary. We could do a whole segment on trusts.
Look, that's interesting. I'll say that. It's probably not my default go-to. Yeah. No. Do you want to just go there quickly?
Knowing what I know now, there are a few properties I would have put in trusts if I could go back retrospectively, but they are for different reasons.
Okay, but what are those reasons?
The reasons are borrowing capacity.
Yes.
That I could lock the servicing into one trust. I don't know why otherwise I would do that though.
So effectively, when Rachel said borrowing capacity, because its trust is its own entity, you could buy a property in that trust and then go and get another property in your own name, and the lenders won't see that debt as you've got that already.
Some lenders, yes.
Some lenders, okay. Another thing just on that trust thing, you'll pay land tax from $1. You won't get any exemptions if it's your first home to live in. You can't transfer. The losses stay in the trust. You can't distribute losses. You can distribute gains, so that could be a potential issue. The other thing as well, people might think I'll do it for asset protection if I get divorced, but family courts can pierce any corporate veil. So, yeah, there's a lot there.
And I have seen a few of those get pierced.
Yeah. A few pierced off people in family court. Darren, I was a bit more of a spender rather than a saver, like most people in my 20s, but I wish I understood the concept of delayed gratification. I'm still learning that, which I'm now trying to pass into my kids or onto my kids.
Yeah. And I do see a big difference with people who do have parents that have great financial habits. They do seem to pass that on. Leonie says, don't get a credit card. If you do, refuse any credit limit increases.
Well, there you go, everyone. That's your words, not ours, everyone. All right, let's get back into the questions from Chris. Can you go guarantor after retirement using equity on income? Oh, I was about to say income protection. You need that if you're young and you're going to get properties on investment property. So I'll just throw you an example, Rach. Chris has a child. Child's 25. Chris owns her house. She also has an investment property worth $1 million. Not much debt on it. She wants to help the son or the daughter who's 25, doesn't want to use the house, or she could be renting or whatever. Can we use the investment property to help the kids?
You absolutely can. So when you're offering a parental guarantee to your children, now just to actually just go back a step, a parental guarantee is when the bank takes a hold or a second hold of a limited amount on a property of yours, whether that be your home or an investment property, or it could be even a term deposit, and they use that as the security or the gap in security of the property that your children are buying. So they essentially don't need to have any deposit and they can go into the property market based on their income alone.
So if we rewind to the start when we were talking about the bank just want to see two things, income to service, security or equity to not lend 100%.
That's right.
However, and this is a lot of people, they can afford the mortgage, but they don't have the spare cash to save for the deposit. Especially
people renting now.
Yeah.
They don't have the ability to save that deposit. So we're seeing more and more parental guarantees in the market. Now, if you are wanting to offer a parental guarantee, you don't need to be working, but it will alter the bank selection for your children. So some banks want you to be working. Some banks are happy for you to be retired and put it against your own home. But there's only 4 out of our 30 lenders that offer parental guarantees that will do that. But they're all great and reputable banks, so it doesn't matter. So when we're choosing a product for a parental guarantee, we will look at not just what's best for the people buying, but what suits the guarantor the most as well, like what's going to suit what they're going to do.
So this is interesting because a lot of parental guarantees that happen, and someone might be in their 50s and they've still got a $300,000 mortgage on a $800,000 house or whatever the situation is, they can still use some of that equity as the security for the children. But what you're saying is, if I came to you and said, hey, Rach, I'm 55 and I'm Glen, it's probably next week, and I've got a child who wants a property, we know that there is an existing mortgage on the parents' house. We know that the kids will get their own mortgage against 80% of the house, but still pay 100% of the mortgage because the 20% security is coming from the parents' home or investment property. So there could effectively be 2 different mortgage or 3 different mortgages, depending how you split it or do the mortgage splits. But I guess what I'm trying to say is your team would have a look and say, on balance, the most favorable outcome in terms of ease of getting it done, serviceability for the children and the rate for the children and the vibe for the children, and also it's not going to cause too much issues for the parents, because you can't, what I'm trying to say is, if the parents had a loan with CBA of $300,000 and the kids wanted to bank with ANZ, you can't use different banks for the parental guarantees?
You can. So you have to use a bank that will go what's called second. So ANZ, great example, will go second to CBA.
Cool. Okay. So again, this is why we get experts on. So there are a million situations that parents can help their kids, because the parent might be like, we've banked with CBA for 1,000,000 years. We love it. The rate's great. We'll help the children, but we want to stay with CBA. And the kids might be like, whatever, just get us out. And
you're saving 30 grand in mortgage insurance. You'll take the bank.
That's right. But the thing is, you can then look at the kid scenario and go, oh, they're not going to be able to service with CBA, but they will with ANZ. So we can tie in ANZ as a second to the parent's property.
Yeah, and that's right. And some of the banks take just a less aggressive hold on the property too. So, if the parents are still investing themselves, they want still flexibility on their securities. So all of those things come into play when you're choosing a bank.
Talk to us about, with this parental guarantee thing, probably a thing that needs to be considered, which I think it's an overall low-risk strategy, but talk to me about a full guarantee and a limited, because we want people to consider limited guarantees in the first instance. Is that correct?
That's right. So we'll only do limited guarantees as a business.
Okay.
And I've noticed that some of the banks that wouldn't offer limited guarantees have actually come out of the market.
Right.
So, and one of the majors would only do a full guarantee. So that's when they're taking the parent's full house as security, which means that if they're getting into a default situation, they can sell the parent's house. Like it's a big thing. And they can choose which house they sell first. So some of those banks have actually pulled out of the market altogether. Traditionally there's been some banks that have done it really well, which is a limited guarantee. And so that means it limits the risk to the parents. So let's say they're buying a property for $500,000. There might be $100,000 guarantee against the parent's property. Now, they might think, well, that's not a huge risk, but it's still $100,000. There's still a risk. So our aim is always to get that guarantee released as soon as we can. So as soon as the kids, I call them kids, they're never kids. We did a parental guarantee recently for someone who was 55 as the borrower.
Okay.
Yeah. That was their first home.
It was like an 80-year-old.
First home buyer. Yeah. Yeah.
I had a client, this is sidetrack, he was 65. We did the retirement advice for him. Lived and worked in the city, Sydney, right in the CBD, rented there all his life. Had never purchased a home before, moved up the coast of Foster.
Wow.
Right, bought his first home in a lifestyle park. So not retirement village. And everyone, there's episodes the last few weeks where we did lifestyle village versus retirement village. We got him his first home owner's grant of, I think it was $7,000 and no stamp duty at the time. And we just had to, and I went up and visited him. Revenue New South Wales, I literally remember getting underneath. They just wanted to see a photo that the thing wasn't on wheels.
Wow.
Yeah, so he paid like $70,000 at the time. Then he ended up not paying any stamp duty and got like, I think, $7,000 to $14,000 in the first home owner grant.
Fantastic.
Yeah, so I mean, this is good stuff. So all that to say, there are options.
There are.
Regardless of your age or stage.
That's right. And that parental guarantee, like I said, can be released when the property value of the kid's property has increased and the loan has decreased and they represent 80% of the value.
Or if there could be a parental guarantee of $50,000 and the kids work really hard to pay down the mortgage to cover that 50, then it's released if the property value hasn't increased.
Can I tell you what my team are doing today?
Ooh. Go on.
So because that new policy's come out that says paramedics, firefighters, police and nurses can do 90% no mortgage insurance or 92% in some cases, they're on the phones calling people that we've done parental guarantees for that were waiting for an 80%.
But now we can release them.
But now it's 90. So if you did a parental guarantee for your children and they're in essential services, you can release them quicker than you thought.
Rach,
or release yourselves.
Rach, you helped me once and I probably shouldn't have done it, but Mum was in a good mood. And it was just because it was transition period. I had my new business. I wanted to buy this
How
another
long
property.
ago was that?
oh God, it would have been 2016 maybe.
Yeah.
So weird, long story short, I bought a little investment property. It was 400 grand. And it was funny because John at the time, I didn't really know John at the time. And I'm just like, my strategy was, it's a really dumb strategy. It kind of worked. I'm like, $400,000, brand new townhouse in a complex of 2. I don't know if you're going to, and right opposite a shopping centre, near a bus stop, all that. I don't know if I can wreck this. It was near a main road because the floor of housing in Australia, particularly around the Central Coast, like 400 grand.
Wow.
And I'm like, oh, hey, I need to do this. And Mum had some money come in from somewhere and she was getting ready to look at retiring. And I would, literally started my business and I was really kind of in the flow of it, maybe even before 2015. Anyway, either way.
Yeah.
You put, I think 80 grand or something or 100 grand in a term deposit because it was only a period of a year and a half that I needed to do this. And Mum's like, yeah, whatever. Like she had the term deposit getting interest, but the bank secured that term deposit against my property.
I remember. And you can still use you can still get the interest and use it. You just can't close the term deposit
because
down
it's secured against
until the
house.
guarantee is released, which is what some people
and
prefer.
And it just kind of worked. Like, Mum had this money. We had to wait. There was some timing thing with the super or whatever. I'm like, look, let's get this, park it. Hey, while it's parked there for a year or whatever, can your little boy, favourite boy, Glenny, just borrow that. And so lots of options.
That's so good. I actually did one in 2007. So it wasn't my first property. I'd bought a house to live in, but there was a really good set of duplexes that came up and it was going to be a mortgagee in possession. I knew I would get it for a good price and I didn't have the equity in my home yet to buy it. So I used a parental guarantee for an investment property, but it was only in place for a year because I renovated it and released it quickly.
But the interesting thing is with this whole parental guarantee thing, and this is why I think it's an important episode, peeps, if you want to send this episode to your kids just to listen to, my first home that I purchased to live in, I didn't use a parental guarantee. I decided to pay the lender's mortgage insurance because I knew Mum and Dad were going to move and I just didn't want to overwhelm them and I just paperwork and I'm just like, oh, $14,000, I'll just pay a little bit of LMI and it all worked out. And realistically, anyone who bought a house 10 years ago in Australia or a property, probably done all right. Look, in finishing, because we are getting close to the 50 minutes, Steph, how many extensions of pre-approval are too many? So got the pre-approval, but can't find a property.
Yeah.
Is there a detriment to keep refreshing?
Look, it just depends. So if you're borrowing, and you're going to do a 95% lend. So let's say the more percentage lend you do, the higher risk it is to the bank. So let's say you're doing a 95% lend and you've got a lot of credit inquiries already. I would probably say you probably don't want to keep extending it every 3 months because all of those credit inquiries can trigger something on your credit file that, changes the risk rating if you were already a high-risk customer. The majority of pre-approvals we do nowadays aren't that high risk, so there's no risk to the client keeping on getting credit extensions or pre-approval extensions.
Yeah, so I'm also thinking in this environment, and tell me if I'm absolutely crazy. I've been told that before. If someone like Steph had a good stable income, had a good deposit ready to go, is there any harm of forgetting the pre-approval, going shopping when you find something like, I think I might put an offer in and and I get it that it's moving market and all that, but you'd have access to lenders that could probably turn something around in a matter of days if needed.
I cannot. On a Monday in our office, it is just contracts exchanged arriving on our desks of people that have not got finance in place. So they go, so many people do it. I don't recommend it, but so many people do it. They go, they buy a house, they're exchanging contracts. They've got a cooling off period and the agent refers them to us and we get the contract. It's already exchanged when we get it. And they say, by the way, guys, you've got 5 days.
Yeah.
And it's very rare that we don't meet that time frame. However, I think a pre-approval is a great idea to get in place before you go looking. So you really have done the research before you find a house. But if Stephanie's done the research.
But like if she knows what she wants.
She's done the research. She's got a pre-approval in place.
She's just now waiting. It's not urgent.
Her income isn't changing. We're not relying on overtime because those things can change. Let's say it's base salary. You've got a 10 or a 20% deposit. I would probably say you're pretty right to keep looking after that's expired.
And this could be a dog whistle, but I have done an anonymous interview with this person before on the podcast on the other, and I just think knowing that you're probably a credit-worthy borrower because the income's there, the deposit's there. Because like with these, some lenders were like, okay, pre-approval lasts 3 months. At the end of 3 months, click yes and ticks over. But some would be like, we've got to recheck financials. So it's like, what do we do?
And some of them will do, there's a 3-month pre-approval and then they'll say, show us your pay slips and we'll extend it for another 3 months. So some of them is every 6 months we're doing it. But if you change jobs, I would say let's go again. But if everything's the same and your broker will guide you on this, there's probably no reason to keep going every 3 months.
Yeah, so there you go. But it's all circumstantial and usually get your ducks lined up before you go spendy, but because it's probably, if she owns her own house at the moment and the upgrade isn't mission critical urgent, she can take her time and wait for the right house.
That's right.
So good stuff there. Well, we might leave it there for today. Lots of questions, good chatter, good all that stuff. Hey, if you want to talk with a broker, you can reach out to Sphere Home Loans directly and one of Rachel's team will be happy just to have a chat and see which way the wind's blowing. And I'll just say, like, your team, they're all salary employees.
That's right.
So if they can help, they will. If they can't, they won't try and help so they get paid like that.
No, and if it's, like I said, if it's 20 minutes guiding someone on where to go that isn't us, they'll do that as well.
Yeah, awesome. So thank you, Rachel from Sphere Home Loans, for joining us today. Remember, everyone, have a plan, however small and simple. My personal plan is I like to give some, save some, and spend some, preferably in that order. I'll see you guys soon. Bye.